Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and comments from real experts on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge freely the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of tax information for tax professionals, federal, state, and now international as well. Let's see what we've got. 5 topics, an average week, a wide array of topics, an article from Tax Notes Today by Kip Dellinger on tax practice, an area in which he is an acknowledged expert, probably the best in the United States. And then a tax court decision, San Jose Wellness, on whether or not a marijuana dispensary can deduct any of its expenses. Are there some expenses that are period costs, like depreciation, that cannot be said to be related to carrying on the trade or business? We'll see what the court has to say. And then notice 2021-15 on extended deadlines for flexible savings accounts in employer-funded, employer-managed plans. That'll be interesting. The strange case of Debra Jean Blum, whose claim for damages against a hospital morphed into a claim for damages against her lawyers who didn't properly pursue her claim. When she recovered $125,000, was that excludable under Section 104 as being a direct result of her physical injury? We'll see what the tax court had to say about that. And finally, this week's special topic, an extended discussion of the standards for reliance on tax opinions, because it has bubbled to the surface in a lot of ways, not the least of which is reminders from the Internal Revenue Service that we are responsible for tax return positions. And given the complexity in the tax law, so many changes and then changes to the changes, it's really hard to keep up, even if you've been at it for a very long time. So we are going to talk about the standards for reliance on tax opinions as this week's special item. So let's start with Kip Dellinger's article on avoiding malpractice in tax engagements. The first thing he advises is choose your clients carefully. Don't accept every client that walks in the door. Make sure that your client has the same philosophy about taxation that you have, and that you will not be asked or expected to do things that are contrary to the way you want to practice and how you want to give tax opinions. We're talking about, by the way, this ties in. Our first item this week ties in with our special item this week. Then you're not a lawyer. Remember that. You only give tax advice. You can give all the tax advice you want that you're qualified to give, but you're not a lawyer. You don't give advice about when to incorporate or how to incorporate or how to document the admission of a partner. That's not in your wheelhouse, okay? You're not a lawyer. Then remember, the claim could be based on what was done, what was not done. You did not do something. It can also be based on what was done if you did the wrong thing. It's important to work in areas that you understand, where you're comfortable. Quality control is imperative. Most firms have quality control in their attest practice, but they're not so diligent about quality control in the tax practice. Kip makes this point over and over again in his article, the importance of quality control in order to avoid malpractice claims, starting with the engagement letter, which is absolutely a requirement. It's imperative. You cannot practice here without an engagement letter, and you should not undertake any type of engagement in your tax practice without an engagement letter that covers the client's expectation of what you're going to do. And document everything. You need a contemporaneous record, same hour, same day, same week. Make sure you write it down currently at the same time the services are being provided. avoid speculation in emails. We've all seen enough in the news, all of the investigations in Washington about that dredge up emails where people have said things that were really not for publication. Remember, the plaintiff's lawyer is going to see all of your emails. Don't make admissions against your interest in emails. They will come back to haunt you. Look at Kip is a prolific author. He's written a lot. He's a member of the California CPA Society, the California Bar. You can look him up online. You can look up his writings. This guy's a dead bang expert. I have the greatest of respect for his opinions in this area, and I encourage you to learn more about what Kip Dellinger has to say about avoiding malpractice claims. Then we have a cannabis dispensary cannot deduct depreciation or charitable gifts. They had some unique arguments here. This is San Jose Wellness. They argued that depreciation is not an expense. It simply is a deduction that's going to happen with the passage of time. The court said, no, depreciation is a cost that is presently incurred, and that deduction is barred by Code Section 280, capital E. Nor can a charitable contribution be deducted by the enterprise based on their argument that a charitable contribution has nothing to do with the carrying on of a trade or business. No. Courts have recognized the benefit to corporations from publicized charitable gifts. So there is a business purpose to the charitable gift with regard to the charity. And with regard to depreciation, it is a cost that is incurred with the passage of time and the assumption that a fixed asset is worth less with the passage of time, so that it is a cost which is presently incurred by a diminution in value, not by writing a check. Now the IRS clarifies health flexible spending account carryovers and claims periods. You can have one of two things. We'll talk about that. Let's get this straight first, then we'll talk about the either or. April the 7th is World Health Day. Just a reminder. Notice 2021-15 gives us guidance on carryovers for health flexible spending accounts and dependent care assistance programs and extended claims periods for those same benefits and post-termination reimbursements from health flexible savings accounts. I'll get this all straight. The employer sponsoring plan must choose between carryover relief or an extended claims period. So a flexible spending accounts are typically funded by employers, not by employees. So you may have funds in a health flexible spending account, or you simply may have a commitment by the employer sponsor to provide funds if a particular expense is incurred. That's what makes flexible spending accounts so great. That the employer says, I'll pay for new eyeglasses for anybody that wants to get them. If you don't get them, you don't have a benefit. If you do get them, the benefit is provided under a flexible spending account, which the employer agrees to pay vision benefits for anybody who makes a claim. Obviously, the people that don't make a claim don't cost the employer any money. So, but the employer is going to be able to choose between carryover relief, allowing the employee to carry over unspent portions of a flexible spending account allowance, or an extended claims period, allowing the employee to file a claim during an extended period, but you can't have both. The employer can select one or the other. A malpractice settlement is not covered by Internal Revenue Code Section 104, physical injury exclusion. Every now and then, you get into clip art, whatever that thing is, and I find a picture that's just dead on. This is Debra Jean Blum, there she is. There's a cartoon representation of Debra Jean representing herself, pro se, because her lawyers let her down. She got a $125,000 settlement from the law firm because they mishandled her claim against the hospital for physical injury. Is the $125,000 traceable to the physical injury? Well, yeah, it is, but it isn't. The $125,000 settlement from the law firm was pursuant to an agreement. The settlement agreement said that payment was to settle all claims against the law firm. Never mind that the origin of the original claim was physical damage. Didn't matter. The agreement, the settlement agreement that got the $125,000 was to settle all claims against the law firm for their negligence. No mention was made in that document of a medical claim. And so the court said, rightfully so, the written settlement agreement controls the tax treatment. Next, no clever artwork here. Experts, all of whom are known to me, one of them is a friend of mine, or was, he's passed. Experts seek consensus on tax opinion standards. While doing my research here, I came across an article by my friend William L. Raby. Some of you know that Dr. Raby and I worked together for over 20 years, producing a monthly tax update, a video tax update. Dr. Raby wrote in 2005 on the issue of reasonable basis. He published 9 books on tax practice for CPAs who prepare tax returns and give tax advice. And Dr. Raby's analysis with regard to percentages and what could work and what would not work, Dr. Raby wrote about a paradigm shift. In Penalty Protection for the Taxpayer, Circular 230 in the Code, Dr. Raby wrote, whereas in the past, reliance on the tax practitioner usually insulated the taxpayer from penalties, in the future, the taxpayer might have a greater tendency to look to the tax practitioner for reimbursement after paying penalties. So the liability for giving bad tax advice is going to fall on you for the tax, possibly, and for all the expenses incurred in arguing with the Internal Revenue Service. Okay, so much for Dr. Raby, who we honor, whose memory we honor here by reference. The current experts are Robert Wood and Richard Lipton. They write prolifically. If you read tax notes, as I do, you'll be familiar with their work and with their opinions. Let's lay some groundwork. The Internal Revenue Code is a complex document. Thousands of pages of Treasury regulations, numerous court decisions, volumes of IRS guidance contribute to the general difficulty CPAs and attorneys have when developing and communicating a tax opinion or advising as to a return position. In my commentary here, I got no daylight between giving someone a tax opinion and advising with regard to return position. There may be some experts who do, I don't, and so we're talking about one thing, that is giving advice about a tax return position, or about a tax position that is going to be taken in a return by a taxpayer who has a liability for tax. Words and terms such as reasonable basis, more likely than not, and should versus will, have been and continue to be a source of frustration and debate among tax practitioners who want to avoid penalties for themselves and their clients, and malpractice claims from clients claiming financial harm from a bad tax opinion. We can summarize the content of this slide by being all of the standards that are contemplated in the AICPA Statements on Standards for Tax Services. Their interpretation number 1-2 contemplates these standards and comments on these standards. These standards are generally accepted among tax practitioners who do write tax opinions and who are the go-to persons in their firms, perhaps, on tax return positions. Now, let's leave the discussion of reasonable basis, realistic possibility of success, substantial authority, more likely than not, and let's talk about two words that we often find in tax opinions: should and will. If I am writing an opinion, if you've asked me for an opinion on the tax treatment of the admission of a partner, and I write that the admission of this partner with a capital contribution of X should not result in, should not affect the income of other partners, that's one level of assurance. Should. Generally 70-80%. If I write the admission of this partner without a cash contribution will not affect the tax liability of any other partner, that is a more forceful position. That's generally 90% or greater. And so we who opine on tax return positions are very careful in our selection of words in general, but we're particularly careful in how we use should and how we use will when we are opining on tax return positions. Well, gang, believe it? For all the fun we have with this, that's it. Until next time, please stay safe. We need you.